Hello, everyone. Good Fed day to you. How are you? Good morning, Shooter. How are you? Kevin, it's Wednesday. I know what it's like not to know what day of the week. I thought yesterday was Friday, so not bad. Hi, NG, Hugo. Everyone doing okay? So I know Blake wants to cover this breakdown in the dollar. Tweeted about it. Hanging in there, Sinatra, Michael. It's okay, Kevin. All right, so was looking for stops to be taken out. Been talking about it for a while. So, I'm looking for a low. Happy Hanukkah. You're in a tight lockdown from today. Where are you again, Sinatra? In Germany? Yeah. Okay. All right. So, we've cleaned out all the stops, but, I am looking for a contrarian buy in the dollar. But when I look at both the Dixie, see this, see this, I can't buy it. I'm figuring, the speed line comes in right around 90, and I wouldn't be surprised if we get an overthrow on it and head lower. I'm going to be very interested in hearing about targets in that. Hello, Mustafa, Sanan. Okay, but I still believe that before there's a dollar crash, and I haven't been long the Dixie, but I'm looking to around 90, maybe all the way down to 88 and a half or a contrarian trade. Probably going to take a couple weeks to turn the battleship around. So if you're going to bottom pick the dollar, go small for your first entry. Okay, so when I look at the whole board, just like I said about the dollar, I also on some longer time frames were diverging in the euro, but short term, this looks like a bull flag, just like the dollar looks like a bear flag, right? You have straight line move, and this looks pretty close to a flag. I've seen bottoms here, but look at the RSI in the dollar. This is a 15-minute TF. So the euro's the opposite. I can't buy a market when the RSI got down to 18. There's no divergence. And same scenario in euro. If it is a top, my work doesn't say it is, with a confirmed high up here at almost 80. All right. One of the few things that, I'm trying it here, and it doesn't take rocket scientists. Euro's up 38, cable's up 86. So, most Canada looks great. I mean, for having a weak dollar, it's having a good day. And Aussie's really bringing up the rear. And I think there's a possibility, even if we get new highs. So I put a piece on here. But if you look at this, see this 2 hour? And I know Blake's been looking at Aussie, a little skeptical of the rally. I'd be interested to see what he thinks. But looks like 3 to me. We actually took out these highs, I think, by a pip or two. So my preferred short, just based upon display of strength while the dollar's weaker and headed to 90 most likely, or 89.90, is what's happening here in Aussie. This I can, rationalize top picking because we're not confirming with momentum. If you see that, give me a why and understand the rationale. Because, we also want to teach you guys a few things while you're here. Free education. What's wrong with that, huh? Okay. S&Ps pressing the highs. It was great to be short on the eclipse. This was the eclipse, and it was only a day trade, like usual. It wasn't a turn. So, if you sold it on the off number at 38.91 and you didn't make money on a 50 handle break, I don't know how I could help you. You have to learn to ring the register. Cup and handle. So we're in the handle, huh? Well, we'll see. Maybe the handle will fall off the cup. And Nasdaq, similar situation. I guess the story of the day is silver acting, way outperforming gold. I don't care how you draw this uh, trend line, but looks like a breakout that I don't trust. Okay, I just don't trust it. And one of the reasons I don't trust it is, you know, gold hasn't even taken out last week's highs. All right. So I'm not going to short it, but I don't believe it. And, it could drag gold up to 1880 again, but I don't see new highs coming in here right away. And I think that the dollar turns between 90 and 88.50 and maybe doesn't start to turn until January. Okay, so those are my views on Fed Wednesday. Kevin, not Thursday, Fed Wednesday. And I'm going to bring Blake in to talk about the dollar breakdown, as he tweeted. How are you today, my friend?
Yeah, I tweeted just a tweet. How's it going, Dale?
Pretty good, man.
No, but I will talk a little bit about the dollar and what it's doing. It was my chart of the day yesterday, and so I think it's worth talking about. And I actually agree with you. There's going to be a level where we turn, or at least bounce, rather.
Yeah.
I don't know if we're quite there yet, but here, let me I'll take over the charts here.
I did notice dollar DSI at 15 yesterday.
Let me see here really quick. 1 second. There's your DSI, just so you guys can see it. If you want to snap a picture of it, which
15.
We pay for this as a company. I usually don't. We don't publicize all this, but when things get kind of extreme, you should pay attention to a few things, and one of them in particular will be right here. Grab a since you brought this up, Dale. Usually I don't talk about it, but let's grab this. And you'll notice right here, Nasdaq.
Yeah,
it's at 93, right? The euro is at 85, which is pretty extreme. Dollar index at 15, as you pointed out. Volatility is actually not too far from pretty extreme as well. But yeah, you got the Nasdaq at pretty unruly areas. Now I'm going to put this away. And let me go back to the mouse. Okay, so this is a tweet from Lizanne Saunders, which I find really interesting. She's the chief strategist over at Schwab, and
she's very good.
She is. Let me pull this up really quick. There we go. Okay, so this is pretty crazy, and this is from actually the charts from Sober Look, which is another pretty decent follow on Twitter. I've followed for years. This is showing you the euphoria panic indexes beyond that of the highs of 2000, and so. What does that tell me? That tells me that we're getting a little extreme, and that doesn't necessarily mean that you need to be shorting stocks today. But I do feel that once we get past December, the beginning of the year is going to be really interesting. I think that you're going to see some profit taking. I think I wouldn't be surprised if we saw some ahead of the new year, but I think we're going to see some profit taking going into at least the beginning of next year. and that should lead to a dollar recovery. So let's talk a little bit about the dollar. And this is I had some euro longs overnight. I sold them at 121.95.
Nice.
As we had this bullish wedge. If you didn't know there was a bullish wedge here, well, if you could have gone to the dollar index and saw the chart of the day that I did yesterday. There's your chart of the day.
Or you could have been in face yesterday and expected euro to make new highs.
Yeah, or if you were listening here, right? And the 161% extension of this last consolidation that we had over the summer comes in at 90 basically, and then you'll notice 89.50 is a bigger 161% extension. Let me go ahead and reset that.
Yeah. That's
going to be the post-COVID move. So COVID lockdown, rally, 161% extension comes in at 89.50. So as Dale said, hey, I'm expecting a bounce between 90 and 88.50, which by the way, 88.50 is the long-term 618 retracement. I would agree with Dale, exactly what Dale said. Now I'd actually look for a bounce a little bit sooner than 88.50, but you don't know what could get the dollar down there. So let me give you an example. Let's say Friday, I'm just using Friday as a number or as an example. Let's say on Friday, the UK EU announce a Brexit deal. It's done, right? Done. It may be a skinny deal. It may not be the best deal, but it's a deal, right? It's a deal. So what happens? I'm just using this as an example, and I'm just using Friday as like some random example. The cable will probably do one of these. We talked about it's a binary event. Boom, we spike up to 140, right? Euro spikes up to 123.50. I'm just using that as an example, right? 123.60, which is the big 88% retracement. So then, you see all the other pairs move up like that. That means that the dollar index probably spiked down and again, I'm using my example of Friday. It spikes down to 89.50. And if that happens, I'd probably take the other side of that trade once we got there, because it happened all at once, because it was a buy the rumor, sell the news event. We get this Brexit deal, may not be the best deal, but a deal got done. And then, when the dust settles, the market goes, hey, that deal's not that great for the UK. And then they sell it. So I'm using this as an example, but that if we got to the dollar index that in that fashion within a few days because of an event, I'd probably be a seller. Now, the difference might be, let's say the UK EU deal continues to drag on and it goes into the beginning of the year. So here we are, January 15th, and EU and UK is still negotiating. That could obviously happen because they've been negotiating for how many years? 4 years now. So what's an extra couple weeks? So let's say the EU, UK is still negotiating. Stocks are continuing to rally, and the S&P is closing in on 3,900. The dollar index probably has grinded down towards 89 in that kind of situation, because as stocks continue higher, the dollar index is probably going to continue lower. So if we, continue to rally in equities and, things are still status quo and we haven't got any resolution on Brexit yet, yeah, I'd probably wouldn't be fading the dollar. So again, it's the dollar. It's not necessarily the dollar getting to a certain level and I want to all of a sudden be a buyer or seller. It's how we get there, which, Dale, we talk about quite a bit, right?
Yeah.
How we get to certain prices and certain levels.
Grinding is different than collapsing.
Yeah, exactly. Yeah. So anyway, what I will say is we have the FOMC today, and the FOMC is probably going to reiterate that they need some fiscal support. So they need
Yeah.
help. Obviously, we have Congress that doesn't want to leave or is not going to leave until a stimulus deal gets done,
Yeah, they
supposedly.
want to leave.
They
That's the only reason it'll get done.
yeah, they
They
definitely
want to
want to leave.
leave.
Schumer no, Mitch McConnell's like, no one's going home until a deal gets done, whatever. But we do have the FOMC, and the FOMC is probably going to reiterate there's a lot of risks. They're going to continue to keep rates low and accommodative policy, but we need fiscal support. Same old. So
isn't that one of your favorite formations that we're getting in euro right there, Blake?
Yeah, this is a pennant. But the problem is, or a flag,
Yeah.
But the problem is when the flag it becomes longer than 50% of the distance of the pole, right?
Okay. Yeah.
So once this flag is, it exceeds too far, then I'm not going to be so excited about it. But it's still, I think it looks bullish. I mean, it's broken out. I think the euro, dips down to 121.70 should be pretty well supported today because it is breaking out. And I'm going to go ahead and write down a few things since I need to pull it up because I didn't pull it up. If you guys are new to this webinar, okay. So I need to write down everything on the bias chart. So with the euro, next level of resistance for the euro, just so you guys know, it is not until 122.63. I actually had an order to take profit there in my position overnight because I'm like, I had as I mentioned, I was long a little euro overnight, and I'm like, okay, if it spikes up there, I want out because you never know when you're sleeping, and you've got European negotiators talking that a deal might get done. So I wanted to make sure that I took profits in the event that we went up there. But this is 161% extension of the this consolidation here. So that should be resistance today if we can get up there post FOMC. So I don't want to say that we can't because we can. I'm going to write just 122.60. It's 122.63, but you guys get my drift here. And I think we should stay bullish, the euro, while we're above this trend line, this red one right here, and that currently will come in around, let's just call it 121.20. So while you're above 121.20, 121.20, there's no reason not to be bullish. Okay. So now I would be a little nervous though, and I'm gonna blurt this out, some verbal garbage at you. If for some reason the euro drops down here to the 60s, which it could, I will start to watch it kind of carefully because then you're in false breakout territory if it doesn't turn higher for the day, right? Yeah. So you got to think about that. But right now we have to assume dollar's weak, stocks are going to be strong. I mean, look at the S&P. I mean, we're nearing highs again. What's to stop the dollar right now? So let's talk about the cable. The cable, if you guys read this last night, and I'm going to put up my analysis from last night. The close above the 135.40 level is above the multi-year downtrend line. I did a typo there. It was supposed to be the close above the 134.50. I actually put in a typo there. Because last night, let me just share with you what I was thinking here. We closed at 134.50, and I wrote 135.50, probably because I was looking at the breakout point, the horizontal levels. But this bar was above the big descending wedge trend line. And so what I meant to write was 34.50 levels above the multi-year downtrend line, and this may be a bullish development. However, a sustained break and daily close above 135 level is needed for the bulls to react. So, what I'm writing here is if we close above 135 today, that's extremely bullish, the cable, extremely bullish. All right. We have to sustain these gains. And, from here, let's just kind of figure out where we might go just in case it starts to run on us. The 127% extension is at 136.50. And I'm going to write that down just in case we start to rally here. And support right now, I think it needs to hold above, 134.50, but also 135 today. Okay. And we're in bullish. We're in breakout territory today. Aussie dollar, still bullish. The problem with the Aussie is we're really struggling at these highs. Kiwi's got the same issue right now. And that doesn't make it bearish, but what that does mean is, dips. I mean, we could see a dip in price back down towards, the 74.50. I think it's possible. I'm not going to be selling it necessarily, but 75 cents should be support. Then 74.50. Okay. We are still bullish. Resistance right now is 75.80. Didn't mean to do that. Okay. Okay. Kiwi is bullish, but again, we have an issue here at the 71.80 level, or I'm sorry, 71.20 level. As noted on Forex Analytics earlier this morning, this could allow for a dip back down towards 70.50, 70.60. What's actually 70.60 right there. So I'm going to write down 70 is support. That's the big support. Then there's 70.60 and resistance is 71.20. It is bullish still, but just be a little careful with the Aussie and the Kiwi because they are struggling at the highs, right? Dollar Canadian. Now, this is interesting. The dollar Canadian, pushed below the 127 level. I was long yesterday at 127.50. I had to run an errand for my wife yesterday, and so and then I put in my stop at 127.19. So I lost like 30 pips here as it dropped through support. Was this yesterday? Oh no, it's right here. I'm sorry, it's right here. So I picked up a little bit, thinking that we weren't going to hit new lows, but as soon as we cracked this trend line support through here, that's where my stop was. And then we pushed lower. Now, there was a lot of comments from Macklin from the Bank of Canada about, hey, they're starting to actually verbally intervene, if you will, into the Canadian. So we're starting to see a little bit of Canadian dollar weakness as a result. And if you looked at like the Canadian yen, it turned from some pretty key resistance overnight. The dollar Canadian, remember, this is still a big 161% extension. And it looked like it just pushed the lows below the figure yesterday and has bounced. But I'm going to say that resistance right now is 127.75, which is channel resistance, right? Okay. It is bearish. And by the way, we have to stay bearish while we're below, in my opinion, right there. So while we're below these highs, no reason to be bullish. Now, that doesn't mean you can't take a counter trend trade on the long side, which I know a lot of, actually, there's several people in our chat rooms that did yesterday afternoon. They went long around the 127 level. So, you know, kudos for them for trading counter trend and making some money there, because that was really the only thing that moved counter trend dollar wise. So that's good. But just be careful because the trend is obviously still down. So support will be 126.85. Dollar Mexican peso. Now, just so you, I want to share with you guys so you know why the dollar Mexican peso broke down yesterday. There was some legislation in, and we talked about this in the Forex Analytics chat room. If you weren't in there, then you might not have known why the dollar Mexican peso dropped. There's some legislation that was in Mexico that didn't pass, but the risk was if it did pass, it would have allowed Banxico and some other major Mexican banks take in essence, drug cartel money. And if that would have passed, the peso probably would have broken down. And you saw it early on yesterday when it was up here. That's when that legislation was up for a vote, and then it started to sell off, which and meant that the legislation wasn't going to pass. But that's one of those things that if it would have passed, it would have probably been a negative for their ratings agencies moving. The ratings agencies would have put in negative ratings on Mexico moving forward, and that would have been bad for the peso. So it will go back up for a vote again, but not, I think, in like next year at some point. So if you want to know why the dollar mex sold off yesterday, and when that news broke, it was right here. It was already at like 1995, like basically a little higher than where we're at right now. But that's it. Anyway, support for the dollar mex is going to be this trend line, which we'll just have to mark the lows again at 1970. Now, resistance is obviously 2020, as we've been writing down. I do think it's in a range. Okay. I don't know if buying it right now is necessarily the right trade, but anyway. Dollar Swiss. So we've been monitoring this channel, very similar to what the dollar Canadian is doing right now as well. So support is at 88. Now remember, 88 is the 161% extension, and we might make it all the way down there. So 88.05. Resistance is 88.85. So 88.05. 88.85. Hold on really quick. I know today's FOMC day. I want to just make sure there's no news happening.
We do have data but we have data in about 50
we
seconds.
Do.
Retail sales and CPI from Canada.
Got it. Okay. Thank you, Stelios. All right. So we're gonna go to that here in just a second. So the dollar yen actually finally broke that 103.65 support pretty well. 103.20 is going to be support, and then below that is 103, which is big trend line support. Okay. Oh my gosh, can you guys hear my dogs? I don't know if you guys can hear that. Yeah, since I got this, could you hear Stelios?
Yep. Oh, in the background.
Yeah, it's I thought this hold on, let me pull up
one of your sons.
Oh, data should be out.
Yep. And retail
Weak
sales
retail
weak.
sales.
Weak.
Yep.
Weak.
Revisions weak as well.
Weak. That's not good. The dollar could strengthen on that. Now, I'm not necessarily in the camp that weak data means weak dollar. I think weak data means strong for the dollar. Risk off means strong for the dollar, right? But I think data is going to start to turn sour, especially at the beginning of this next year. So, but remember, we're riding on fiscal stimulus hopes and all sorts of stuff. So you're seeing the euro actually push a little lower right now. We should come down and retest that 121.70 level right here. So just a little heads up. Should get down there. Let's see. Okay. Sorry, let me continue on. Dollar yen. So I'm going to write down 103.20. And right now, I think 103.65 should offer resistance on the way back up if we make it. Okay, let's talk about the dollar index. I know we already discussed it, but let's talk about it again. Dollar index resistance now should be 90.45. We are in a bearish trend. Oh, this one is bearish too. Support is 89.92. So I'll write down 89.90. US dollar Norwegian krona. One of the things about the US dollar Norwegian krona, and I meant to bring this up to everybody else this morning in the chat room, and I totally spaced it. We've pretty much completed the double top, right? So if you guys are wanting to trade something counter trend, the US dollar Norwegian krona might not be a bad choice. We're holding horizontal support here at 864. Relative strength has been divergent, and we've pretty much completed the double top. So you could argue that we're in a huge range now. Again, if you're really wanting to play counter trend, that might not be a bad choice. Support is, you guys know, I've been writing down support is 863. We went as low today as 865. That might have done it. Now, I'm not bullish, I'm bearish. I'm just saying if you guys are thinking counter trend, that might be, not a bad choice. Resistance intraday will be 875, which will be right here. And then obviously you guys know that, 890 and then 896, but I'll write down 875 for.
Hi, Joshua. If you join, subscribe, you could be part of our chat room. And
is somebody asking about it?
Yeah. And if you go to our website right now and tell whoever helps you that you came from Face, if you go semi-annual or annual, they'll give you a discount. Okay.
Yeah, and this is our chat room, just so you guys can see how active it is. I'll show you when I got up this morning.
It's our Christmas present to you.
Which was 2 hours ago. Or 3, maybe 2. Where am I? Okay, right here. Well, it was my first post at 4:48 in the morning, and it's 6:34, so it's less than 2 hours ago. So you can see all the charts, all the stuff, and all the talking, and all the charts, and all the, that's for the last less than 2 hours. So yeah, the chat room is where you're going to find most of us throughout the course of the day. And that's on top of all the technology you get with Forex Analytics, with the platform, with all of the tools, whether you're talking risk management tool, live squawk, which by the way, we're going to be offering audio live squawk from live squawk at a discounted amount from what they offer, just so you guys know. So if you're using Forex Analytics, you're going to get a discount to squawk service coming up. Then we have, you got, live charts, and then you've got an app that, notifies you when all these support and resistance levels are breached, and, when there's a new pattern in play, and, you got live stream and calendar and Twitter and, all sorts of fun stuff on Forex Analytics. So
what a great site.
Yeah. I mean, all that for, $119 a month. So that's for the full version. It's very,
All right, the link is out there, guys, if you want it.
Thank you. Okay, where am I at? S&P. So S&P, we're still in this ascending wedge. We got to be a little careful here as we approach this. Well, you guys know the 127% extension is 37.44. So I should write that down. I mean, I really should.
That's a nice look.
We're bullish. Well, we're above 36, 35, but 3,600 really. I'm going to write down both. Gold. Now, it's interesting, Dale. You said something earlier. I heard you said silver. I don't trust the breakout.
Yeah.
And we had this inverted head and shoulder pattern. We said yesterday, if we break 2450 on silver, it's going to, spike up to, well, here.
Yeah.
I'll read it to you. This is the analysis on silver last night. We closed at the 2450 level, which looks like the next resistance is at 2518 level. 78% retracement is in play now.
Nice.
The high was 2527.
Well, you better clean it up.
Yeah,
You're off by a dime.
Off by
yeah.
9 cents or whatever. But what's interesting about that, Dale, and that was last night to today, so it spiked out. But you said I don't trust it, and then gold, did a very similar move. We broke this trend line, and gold's actually down on the day right now. I know data just came out, which is influencing it, but if I was long gold, I'd be a little nervous at the moment. Right?
It'd be saying, darn, why didn't I buy silver?
Yeah, right.
That's what you're saying. You're in your head, right?
I am going to write down these two numbers as we talked yesterday. So 1820 and then 1880 or 1875. We'll just write that down. So 1820. 1875, and I'm just going to leave it at range right now. But there's your bias chart. It is, it's finished. So, good morning, Stelios and Steve.
Good morning. How is
you guys
everybody on this lovely day of lockdown?
On just another lovely day of lockdown.
Yeah.
So what's going on?
One of those 2020 days.
Yep, just another day in 2020.
Yep.
So today we have the FOMC. As you guys can see, the dollar is trying to break lower. The euros, are we going to get a dollar follow through right now ahead of, the FOMC? Probably not. But what can the FOMC say today that will continue to keep the dollar in its downward trajectory? What do you guys think?
Well, that's a good question. I think the main thing that everybody's expecting is the Fed to keep the pedal to the the foot on the pedal, and they just keep going. What can they say to make the dollar go lower? More of what they're doing, which at this point I think is relatively unlikely. But given that things seem to be slowly coming back to some kind of normality. I don't want to use the word normality because we're nowhere near normal, but the readings are coming back a little bit. Things are steadying a little bit. Obviously, there's still measures against COVID in various countries and states in the US and all that, and other countries as well. We know that. So things are not good, but they're not deteriorating. So for the dollar to keep going, I think they need to do more, and I don't know if we're going to get that today. I don't know what you think. Do you think, Steve?
Yeah, I'm not on the same camp, Stelio, because I think that for many valid reasons that we've explained in the past, the dollar is in a downtrend, and I think we should apply the opposite thinking, which is what can they actually do to reverse the dollar higher? And I don't think they will try to do something like that. So, as long as I don't have something solid, something tangible, I keep looking lower in the dollar. Yes, I'm fully aware that at some point we're going to get a squeeze. There's
I
no
agree
question
with
about
that.
it.
I agree with that. I do. But I'm just saying, what can they do today specifically to make it
That's
go
the
lower?
thing. I don't think they need to do something for the dollar to move lower. I think the only thing that can change is if they actually say something that might reverse the dollar higher, which, I don't think it's very likely because they don't really want to, change expectations having to do with, the amounts of stimulus, accommodation, so on and so forth. So
The Fed really isn't supposed to talk about the dollar. That's the Treasury's
Dale,
domain.
if we start a short list of what the Fed is not supposed to be doing,
Well, that's one they haven't broken yet.
we're actually going to write a book about it.
Okay, well,
I
this
remind
is
you that
just
the
one.
Fed is not supposed to be buying corporate bonds. The Fed is not supposed to be monetizing debt. The Fed is not supposed to be coordinating directly with the Treasury. Do you want me to keep going?
All right,
That's
guys.
enough.
Well, hey, I'm gonna pass it over to you, but I want to say happy FOMC Day, and I want to thank all of you that are supporters of Forex Analytics. Thank you guys for listening in every day. Thank you for those of you that are actual members of Forex Analytics, your clients, because I love chit-chatting with you guys all day long in the chat room. And remember, if you want to try to get Forex Analytics for free for a few months, you can go to the Forex sponsored page. And Pepperstone Securities is our webinar sponsor. If you open an account right here with this link, this will connect you to Forex Analytics, and you can get up to 4 months free with Forex Analytics. So click that open account there, and I'm going to pass it over to you guys. So it's all yours.
Thank you, Blake.
Good hunting today, Blake.
Yeah, thank you. And I will see those of you that are Forex Analytics subscribers. I will see you on the daily roundup, which happens to be before the FOMC. So I'll see you then.
Thank you, Blake.
Bye-bye, mate.
Bye, guys.
And Blake talked about the platform and everything. One feature that I personally use all the time is because you can have push notifications on your phone. When I'm out and I'm not in front of screens, I can tell straight away the markets are moving because I get bleep, bleep, bleep on my phone that, this thing is breaking, that thing is breaking. It's fantastic. And when I look at my phone and nothing's happening, I know markets are sideways. And I know it's a small thing, but it's so important, for me that I look at markets all the time. It's very important. So it's just another
Great point.
Speaking of which, Stelio, it's also a good thing that notifications are fully customizable, right?
Yes, you can do
So
it
you
for,
can
yeah, you can
customize
choose
what
which
kind of
ones.
notifications you want to get and for which instrument. So in essence, you don't have to be spammed for things you don't care about. You can only receive notifications about, instruments you do care about.
Yes, absolutely. I personally use that all the time.
That's FX website out there, man.
Well,
because it was designed by an anal guy. So,
yeah.
So I mean, a control guy like Steve. So everything that Steve would want before he built this is in there now after these years. Is there
Whatever.
anything missing, Steve, that you still want?
We always find things to
I
to
know,
add over
I'm
time.
kidding.
Yeah.
There is a
Okay.
Greek saying translated is that the enemy of good is better.
Yeah.
I like it. Yeah.
Those
Yeah.
Greeks, bloody Greeks.
Yeah, bloody Greeks.
Okay. So
So Stel,
I think
what else?
Blake mentioned
we
most
see
of
we see
sorry.
that the pound is euphoric today.
Yes.
Incrementally broke to new highs, currently testing this confluence of the previous high. And yes, once again, this ascending channel trend line resistance in play. Where to from here? Any news?
Well, we had von der Leyen who said that there is a narrow path in view for a trade deal in the next few days. So that's what's pushing the market a little bit higher. And there is general optimism that something's going to be done. My views stay the same. And as long as we have nothing concrete, I'm not going to change them at the moment. So, I mean, not much more to say about the UK and the EU. Really, the same things over and over again. I don't think we should be repeating them.
We just have to wait now.
By the way, cryptos are breaking Bitcoin new all-time high, so that we're going to have a look at.
Yeah, here it is actually.
Yes.
Not a big surprise because look how I had indicated this formation here. I mean, initially it looked like a triangle. It could evolve in something a little bit different, but bottom line, it was more than clear that it was some type of a corrective formation. RSI also was confirming this outlook. So I have to say that I'm not really surprised it's breaking out because technically speaking, that's what was expected. Ethereum has not followed yet, but we've seen very frequently Ethereum lag a little bit Bitcoin. If this doesn't prove to be a false breakout, meaning if it doesn't reverse like immediately, I'm pretty sure that Ethereum is going to be following within the next.
You saw the last Bitcoin move where it moved like 30-40% higher, and Ethereum went 300% higher. So it's always overreacting and then consolidating and then following, just like you said, it's following Bitcoin. So yeah.
Yes, exactly.
And altcoins in general do that. So
yes,
I'm too scared of them.
To be honest, I'm not paying attention to anything other than Bitcoin and Ethereum because I know there are several cryptocurrencies and coins out there. But let's be honest, between the two of them, I think they share the vast majority of the market share, right? I mean, they capture the vast majority of the market share. So I don't find any reason why I should be following like the rest. I think the two of them are more or less indicative of what's happening in that segment of, let's say, the market. Okay, what else do we have still?
You ever trade the Volgi?
No, just Dogecoin.
The Stelios coin?
Hadn't they made a Dogecoin?
Yeah, they did.
Right?
Yeah. The Vulgarium. Anyway,
the Vulgarium.
Funny, I was reading actually something that was saying that the most crowded trades at the moment are short dollar, long stocks, and long cryptos, which is interesting. Anyway,
that trade at some point is going to blow up in their face, but I don't think we have any elements in the making that we're going to see a squeeze that's going to be more than short term.
Yeah.
So I do think that all these people that are stupidly jumping on the train so late are going to feel the pain, because the vast majority of the idiots that are jumping in trends very, very late are also, unfortunately, the people that are also use leverage. So, these are the people that are going to first, get destroyed before the market can keep squeezing higher.
Yeah, that's very true. What else do we have? Some data to mention today, although data is rarely important these days. But UK CPI, it dropped to 0.3% year on year, so worse than expected. Remember, we had the average earnings growth yesterday at 2.6%, if I'm not mistaken. So that's a nice little gap there. Between the two, we had PMIs in Europe and in the UK overall beating expectations, but either at high 40s or low 50s, so really not they were anywhere near recovery. And of course, we had the retail sales in the US, which missed. We're all expecting the FOMC today, obviously, and also New Zealand GDP. That's also worth mentioning. Now, the funny quote of the day was that the US Treasury said, I put this on the chat room a while ago, the US Treasury said it has determined that both Switzerland and Vietnam are currency manipulators. And I wrote, that's so funny. Name me one central bank that isn't. So anyway, that's what they said. I don't know what the point.
So let me understand. Japan is not manipulating its currency. The US is not manipulating its currency. China is not manipulating its currency, but Vietnam does.
Yeah, I don't understand actually what
I feel informed now.
Yeah, but what is the point of making these statements? I don't get it. Are they threatening someone? I don't know. Anyway, and actually, just like Joe very rightly put on the chat here, the S&B is probably the one that states it explicitly. You know, we're intervening. End of story. That's what they're doing.
Yeah, the S&B at least is the only honest player in the game. I mean, they say what they're doing, which is anyhow obvious, but they're not pretending they're doing something different. You know what I mean? At least, they directly outright doing what they're doing, buying stocks, intervening in the FX market, and at least they're saying, we're doing that, we're doing the other thing, we have that level as a floor or whatever. I'm not for it. I think the market should be left alone to do what it wants to do, and that's best for everybody. But at least they're not pretending.
Speaking of Vietnam, DJ writes here, manipulating the dong. Oh yeah. Yeah, anyway.
I mean, these Vietnamese guys, they're distorting the global financial markets. I mean, unbelievable.
Aren't they? Yeah.
I think we should invade them.
Anyway, that's
last time that didn't work out nice.
Yeah.
Now that I think
or the time before when the French did it.
Yeah.
Or the time before when the Chinese.
And somebody else must have done it.
Yeah.
Anyway. I don't have much else to say. We're waiting for the stimulus deal to be actually officially announced, but I think it's
useless information of the day. You know that the US lost 10,000 aircraft in the Vietnam War.
Wow.
Yeah. Helicopters count as aircraft. Just a reminder.
Okay.
The deer hunter.
Okay, let's let Aliki do the rest of the analysis.
Yeah, Aliki actually has some things he wants to say. Aliki, what do you want to say? There you go. There you go. Okay. I think she just condemned the Vietnamese central bank for manipulating the dong. Speaking of the Kiwi, Stelio, since we do have New Zealand GDP today, quite an interesting confluence of resistances exactly where we are. So we're going to be waiting for the news today at quite a nice resistance area. This is the confluence of the 78.6% fib from the, let's see, it's the 2017 high, right? Which actually was a 5-year high for now. That's the 5-year high. And the 127% extension of this last bearish leg lower. So coincidentally or not, probably not, the Kiwi has actually stopped exactly at this area of resistances. And pretty sure today's data should give us a direction following that. We break higher, probably we're going to squeeze a little bit. We get rejected from there. I think at the very least we should revisit this channel's trendline support. If we are at some point to have a bigger corrective move lower, which probably will have to be accompanied with some risk off and so on and so forth, the level I would have my eyes set on would be a retest of this descending trend lines broken. It was a resistance, it's now broken, and it might act as support backed at 67.50. At some point, the key will have to have a corrective move. Don't forget that since 20th of March of this year, it has actually it hasn't stopped moving higher, right? We've been producing higher lows, and that's the name of the game here. So let's see what happens. Aussie also at the 78.6% fib. So both of them at interesting resistances. But as I said, I don't want to fade the dollar. I don't want to fade risk until I see something that is worth catching my attention. DXY also breaking through this descending triangle. For the time being, there is no indication that we should be fading these trends. Anything else, Stelio, before we jump on the rest of the charts?
No, not from me. Sorry.
Something for me, Steve, since you pointed out those fib levels in Kiwi, we have anything similar in Aussie?
Yeah, we have here the 78.6% fib.
Okay. Because
from
that
that
is
from
okay.
that high, the 2018 January high. So we're
Okay.
currently there. It's 76 is also a nice area of resistance. So we're testing resistances here as well. In both cases, we're overbought. In both cases, the risk reward is really stupid trying to buy them here. I do believe that they will keep benefiting over time.
Yeah.
But should you be buying them here? I mean, if you haven't bought them in all this run to the upside, is this the place to do it? No, it isn't, right?
I'm going to wait for 66 to buy it.
In which of the two? Aussie, Kiwi,
Aussie.
with 66. I doubt you're going to see that again.
All right.
Not impossible, but I wouldn't be betting on that either.
Okay.
Speaking of the Aussie and the Kiwi, copper, also relentless. I mean, doesn't want to stop. So we had that negative day, which we've almost already retraced after 3 days. Yeah, risk reward is also stupid to be long here. But I have to admit, I mean, this thing is, it just doesn't get sold without buyers immediately stepping in. So, it's worth noting. I think we get back to 330, probably it's going to get a lot more buying coming through.
Dr. Copper high on its own supply.
Yeah, Dr. Copper is showing what the rest things are showing, that anything with
inflation
value.
pop.
Speaking, inflation pop, and that answers also somebody asked. Somebody else. Let me see the question. Probably not a frequent listener.
Oh yes, you want to know if you thought there was inflation or deflation. I
Yeah,
saw that question.
yeah. I think that with central banks now turning the direction of monetary policy in combination with governments through a fiscal delivery, because don't forget that the main the main enablers will keep on being the central banks, right? Because governments cannot produce fiscal stimulus being so indebted without having central banks actually buying up all the issued debt. So now it seems that the direction is going to be changing, at least somewhat, in injecting inflation, using now the traditional definition of inflation, which is the expansion of monetary supply. So injecting more of the inflation from the bottom up instead of the up, or at the top, and hoping it's going to trickle down. So I think in this case, the chances that we're going to have an inflationary spike have substantially increased, substantially.
Steve, that pink channel that you have in the silver up there, the top line, did you just clone it off
we
the
tested it earlier today.
Yeah, the top line, did you just clone it off the bottom line, or?
Yes.
It looks very parallel. So
yeah,
it's a different look than a lot of people have. A lot of people show, like my chart show, silver breaking through a trend line. That's a nice line there.
Yeah, I took both the wicks we had in this day there and in this day there, and we actually retested that, to the pip earlier today. So, from a risk reward perspective, just from a risk reward perspective, you want to be short. You believe that the reaction of the market to the Fed today is going to be a dollar pop. Nothing is unlikely, by the way, right? My previous comments didn't mean that it's impossible for the dollar to rebound. At some point, it will. As I've been saying every single day, though, and so far I've been vindicated, is please don't wake up every day, crossing your fingers and hoping that's going to be the day. You really want to be short precious metals, and you believe that ahead of the Fed today that we're going to have some reaction higher to the dollar. This is a perfect technical level for silver to move lower because it's retesting this channel. Now, personally, as you know, Dale, I only want to be a buyer of precious metals. I don't want to be a seller.
And actually, if you want to fade precious metals, I don't know if silver's the one. Short the weak sister, gold unchanged.
The gold among them. Yeah, gold has definitely rebounded less than silver. Testament to that is the fact that it's still substantially away from the equivalent channel trendline resistance, right?
Yeah.
Yeah, that currently passes from 1920, and we're like roughly $70 lower as we speak.
Okay.
Do we have an interview today?
Yes, we have a Dem at Radical Adem is with us. Always has some interesting things.
Nice. Okay, we had more questions. I'm gonna please throw them again tomorrow, and I'm gonna answer them. Thanks, Dale. Enjoy the interview.
All right, buddy. Thank you, Steve.
Bye-bye.
Hi, Adem. I'm gonna get you set up, buddy. Okay. Welcome back to Face, Adem. Yeah, you're breaking up a little bit. Now you're better. How are you?
Okay, yeah. Great. I'm doing good, sir. How are you doing?
Good. So great to have you back in front of, wrapping up this year of 2020. If you want to share your screen. That green box.
Let me pull it up.
And curious as to what's on your radar. Okay.
Yeah, so
corporate bonds, LQD.
Yeah, this is just like some of the old stuff, but the real thing I've been I know we talked about last time, uranium. I've really been enjoying the uranium ride the last week. Finally took a year to work out.
A lot of people actually have started talking about uranium lately because it's breaking out from a major formation, right?
Yeah, see, I don't follow the technical trade, but the supply side, since
from a technical perspective, it looks also very, very interesting.
Yeah, it's going to be a part of the whole global green energy push. Nuclear reactors, the modern ones, supposedly safer. So yeah, I've heard this at Dem, and you're a guy that put me on to looking at uranium issues, and they say how small like gold and silver miners are, the whole universe, that if you just took one day of IBM's volume and put it into miners, it's like a garden hose that it would just make them blow up. And uranium issues are like a straw, where it takes even less oxygen because doesn't take as much money to move them. The market cap of all of them is not that large, right?
Yeah, and especially
part of the attraction, isn't it?
Yeah, and also a big thing on uranium. So I know a lot of uranium has an interesting last 10 years, and the uranium fin Twitter, like financial Twitter, a lot of them are kind of like fanatics. Like they've been holding uranium since 2000. Fukushima happened in 2011, which prices collapsed. And I actually, I don't want to come off as another uranium fanatic, but since 2019 we've seen, so a big thing I like to look at on the fundamentals is the capital cycle, which there's a book by Edward Chancellor. I don't know if you've ever read the book The Devil Takes the Hindmost, about the historic bubbles.
No.
It's a really popular book. It goes over all the big bubbles throughout history, like Tulip Mania, South Sea, etc. Well, that author wrote a book. I mean, he was an analyst for a big fund, and his name's Edward Chancellor, and he wrote a book called Capital Returns, and he basically shows how there's a strong correlation between not even looking at the demand side of a commodity, because demand side is very fickle. Perceptions change. Like investors say, oh, China consumption one year, and then it could change. Like COVID happens, and it like suddenly there's like a glut of oil when there was like a tight market before. So
Right.
instead of focusing on the demand side, it's more prudent to focus on the supply side. So for commodities, I always just try to focus on the supply side. And a big key tell is when you see year over year production of that commodity start declining. So for example, uranium, even after Fukushima happened and Japan and Germany started dumping their spot uranium onto the market, uranium production was rising year over year for up until 2017. So even as prices were falling, these miners were producing more. And it makes sense. I mean, they spend billions to build these mines, and these firms, from like a prisoner's dilemma, they can't turn off the spigot, even if it's prudent, even if they all got together and said, hey, CEOs are saying like, we can't make money at these prices, or et cetera. Why don't we all, stop producing? It'll push the price higher. Well, one CEO doesn't want to be the one to do that, even if it's prudent, because they can lose market share. And how do they explain to their, other shareholders, like, hey, why did we back off production when everybody's ramping up production and we have debt to service, et cetera? So it kind of puts these companies in a reflexive, like amplifying feedback loop. So the lower prices go, so let's say uranium fell from 60, 70-ish to 20. That means a miner has to produce pretty much 3 to 1 as before just to make the same revenue. So now you have the glut even worse than before. So sorry, the point of that was, so the capital cycle, once there's a big lag effect. So the thesis for uranium in 2011 up to 2015 was like, hey, there's gonna be a deficit problem, but there's a really big lag. So investors started buying years ago, expecting, and one thing I've learned is markets are not efficient not as efficient as they're supposed to be. So there's a really big lag effect, even though the supply deficit story was here for a couple of years. But finally, in 2017, we saw global production, which hit a record high. In 2016, it's now down like 22% since 2016 peaks. So we're already seeing suppliers now, mainly the marginal producers. Kazakhstan is the world's biggest producer of uranium. Like 50% of uranium just comes from their main mines. They've started cutting back production. Then Cameco, which is in Canada, the world's other largest uranium producer, they had a marginal producing mine called the Cigar Lake asset. Well, that just because of COVID just went off. Well, it was offline, and then they tried to bring it back on, and then they just said, hey, it was a mistake, and they just went back offline. So the supply deficit problem was already looking attractive in 2019 because of the supply side plunging, 20%. But now we haven't even priced in COVID. Yeah. So
focusing on supply rather than demand, it really is interesting. I think that's going to play out in the grain complex too.
Yeah.
Although demand is good, but where's uranium trading right now, Adam?
It's around like 30, maybe 31, which is also a key thing that I find very. I have a chart. Let me.
Yeah, let's see a chart. Are you glowing? From profits or from uranium?
Oh yeah, big time. Well, because remember when we talked last year, I told you I was buying long dated 1 year out of the money calls on Cameco when it was at like $10. Now it's at 14. So 700-800% higher. Well, see, that's the thing, because that's why I like this roundabout strategy. Is I could just load up on cheap. Like another thing, I'm going long the US dollar for long dated with long dated puts on the euro and the Swiss franc, and it'll probably expire worthless. Like at this rate, people will look at me and they say, what, are you crazy? And I say, like, yeah, I actually think the dollar will probably go lower, but on a expected value perspective, the money's to be made if that doesn't happen. We don't have a crystal ball. Something could happen in a year from now. So I don't mind losing like little, let's say I make $1,000 bet on uranium once a year, and then I lose like little paper cuts, $1,000, over a year. That's what, like a little bit less, a little bit more than $100, but a month in burn rate. And if you lose that, like let's say 5 years straight, so you're down $5,000. It's like little paper cuts, but you're not going to blow up over that. Exactly. But then this year happens, boom, up 10x. You actually, on a compounded annual growth rate, subtracting opportunity costs, you're up 100%. And it's always hard to say, hey, you're betting on a black swan or something. But one thing I've learned is, yes, black swans are rare, but they're not nearly as rare as the implied volatility and the market's price in. You know what I mean?
Yeah.
So,
Yeah.
but yeah, I'm sorry. So that was
Yeah,
just a
no,
little-
keep going.
So yeah, no, that's just one thing I've learned is like the money and the markets is made on that delta where expectations are and where like
Mhm.
reality hits. But the problem I've had a lot of people say, like, I have one friend who's an analyst and he's like, oh, I don't get it. He's like, profits on shippers, everything are down, but their stocks are up 50% year to date. Like, how is this possible? And I'm just telling him, like, the more the banks ease, it allows these big funds to roll their positions over. And like these investors and hedge funds are betting on a far distant future. Like they're like, yeah, the data sucks today, but in 2 years from now, it'll be better. So these stocks are considered cheap, thinking what, they could be. Now, I don't believe that, but I mean, a lot of these big funds, that's how they're playing it. They're just rolling their positions over because if the bank can keep liquidity low, like Greenspan in the 90s, he was like, I'm just going to keep liquidity real low so that investors don't have to dump their positions and, send the market tumbling. So they can just keep rolling them over, keep liquidity going, bids find the asks, vice versa. And until there's something really big can happen like the COVID. But, then there was like, 2000, the 17 volatility suppression. Then there was like the 2019, remember in December or the winter, the Dow fell like 20%. So my thing is that these big crashes that are like not supposed to happen, they actually happen way more frequent. There's actually a big thing I like to look at on the VIX. So when you look at the VIX, you can kind of see how, are you able to see my chart on my page? Okay, cool.
Got it.
So you see how it kind of goes low and then all of a sudden it's like a big volatility spurt, it goes boom, boom. But this is just the last 5 years. So if someone was just buying long dated 1 year calls on the VIX, every time it hit 10, once every year, theoretically, if you survive or if you got them cheap enough, you'd make a ton of money. Also, like this, like all of a sudden, VIX hit an all-time high, I think. Yeah, COVID or near an all-time high. It just shows like how Nassim Taleb, the author of The Black Swan, and he wrote a book called Anti-Fragile. And I think it's really important because he said, instead of being hurt by big black swans, like blowing up, do the inverse of it. Use a little bit of money to like tail hedge, buy puts on positions that may seem, like volatility. You could just buy like every year 1% of your portfolio on calls on the VIX when they get really cheap. And then something like a black swan happens, you can make 50x on that, $1,000. So, you know what I mean? Then all of a sudden it justifies the cost before. And I hear a lot of people say, yeah, but you don't know what'll happen. Like I remember a year before this, I was buying calls on the VIX when they were at like 11. And this guy was saying, yeah, but you're going to lose a lot of money on the options before that works out. And it's like, yeah, that may be true. But historically, from all I've read and everything I've working as an analyst in the past, humans are biased and we have a thing called recency bias. So when things feel good recently, we think they're always going to be good. Exactly. And then the market prices that in. So you take advantage of those biases and you look for the positive expected value. And that's a term by Michael Mauboussin. So I like to combine all those things because there's a famous psychologist, Daniel Kahneman. He wrote the book, I forgot the name. It's a very important investor psychology book. I totally forgot the name of it, but the author is Daniel Kahneman, and he came up with a thing called prospect theory. And that is humans feel losses about 2.5 times more than equivalent wins. So investors, even if, actually, I'll just pull up a chart of prospect theory.
That's interesting. So they're more wounded by the losses than they are healed by the gains.
Yeah, exactly.
Okay.
So
Are
on
you
this chart,
euphoric?
if you see it right here, so an equivalent gain of, let's say 100, a loss, I mean, it's not symmetric. So a loss of 100 is equal to a $100 gain. It means the losses are felt more. So a $100 loss feels 2.5 times more than making $100. So that's why we always want to be right. That's why, we a lot of people confuse, and Nassim Taleb brought this up wonderfully in his book, and it really hit me. He said, profit and loss isn't about being right or wrong. Some of the best investors in the world are the worst forecasters. And the ones who are supposed to be the best forecasters are the worst investors. Because when people bet on what they think is right or wrong isn't what's going to happen in the future. So for example, on prospect theory, that means people want to have those small equivalent gains, even if they risk blowing up. Like, you know, we've seen Victor Niederhofer in the 90s, long-term capital management, all these subprime things. It's like they'll make those small, you know, 20% year-over-year gains, which, you know, relatively big, but they're doing it with so much leverage that if one black swan happens, they blow up and it can almost take down the world with them. That's what happens. And so when investors bet what they think will happen in the future, it's because they want to feel like they're right. And they like feeling right. You know, for instance, like I don't like watching my uranium calls expire worthless year over year, you know, but you know, it sucks to look at. But then, you know, a big event happens and boom, you're up 5-10x in like, you know, a few days. And yes, it's rare, but what I'm getting at is, so on prospect theory, it just means that humans are like they feel losses more than equivalent gains. So we're loss averse. And when investors have that psychology into investing, that means they want to go with what they feel is right, even though that isn't necessarily the best investment. So another way I would look at it is, like I was saying, I would bet against the US dollar at this point, and not because I think the dollar long here is a great play, but because it's already priced in low, it's overcrowded. Yeah, it could go down further, but the huge gain going down now isn't as it was, you know, a year ago betting against the dollar. So at this point, the expected value is if something goes wrong and like, let's say deflation hits, or the ECB or the BOE or the, you know, BOJ, they all out ease the Fed, you know, in the next year, and sentiment changes, then all of a sudden you see the dollar soar versus the euro and the franc, just, you know, for example. And then that's where, like, you know, the big gains will be made because it's not priced in today. So I hope I didn't, you know, lose you on a bunch of my ramble.
You know, I respect and enjoy your thinking.
So, I appreciate it.
Yeah. So, and I learn from you every time you're here. So, interesting about, you know, how losses really scar people, probably also affects their future decisions because they don't want to feel that pain anymore.
Exactly. And it makes total sense. Like, one thing I've learned is, like, I have people who are friends, and like, I consider myself a contrarian investor, and I'd say, like, you are as well, and, you know, a couple other people I know that, you know, but the crowd isn't. And I have a good friend of mine. He's like, Adam, I don't get it, man. Like, my stock's going down, blah blah blah. And I tell him, like, dude, when you're contrarian, you know, it hurts, and you kind of want to look. It's like you're being a rebel. Like, you lose more than you win, but you want your losses to be really small, and your upside have unlimited room to run. So, like, long dated options, buying long dated options instead of selling options. Selling options, you're taking a little bit of money, that's small equivalent gain, but you risk imploding yourself if you don't, if they're naked options, especially. Like, you can, you know,
seen it
quick. And it happens way more often, you know, than many people realize. And because, you know, see recency bias, you're like, oh, you know, that, you know, it doesn't happen that often, but it actually does. And so one thing I told my friend after I learned, like, after doing this like years, you can tell somebody about contrarianism, but you have to be, and you can tell people about economics and capital cycle and etc., but you have to be born a contrarian. You have to have that mindset, you know what I mean, that you can look at your losses, you know, losing money or betting against the herd. And I have, like, some friends, and I realized later, I said, hey, you shouldn't be doing this because it makes you sick. It makes you uncomfortable watching those little losses happen. So, you know, just, you know, do what makes you sleep at night. But, you know, my opinion, I would also say, use a little bit of your money to buy portfolio insurance using, you know, optionality.
Yeah, people are saying that's a waste of money now. And so, you know,
when premiums are high, yes.
Yeah. Yeah.
So after COVID, I wouldn't be buying, you know, VIX or optionality, but when it settles.
All right. The other two most crowded trades, Stelios, my partner here at Forex Analytics, said besides the dollar is Bitcoin, it's crowded, and the stock market, euphoric and crowded. You doing anything there?
I'm waiting for the VIX to go lower before I, load up on my anti-fragile trade.
Okay.
But yeah, I mean, I
You have
think
a number in mind, like 18 again or
I
17?
personally I like it below 15, just because I feel like,
Okay.
especially with how much volatility suppression, but just so any of your listeners know, that's just an arbitrary number. Like, honestly,
Okay.
there's no reason. From the history I've done on the VIX risk reward, I find when it gets below 15, that has the most upside within like a 1 year time span. Like, usually there's some kind of event that happens that shakes the VIX higher than 15, where my puts won't expire worthless. I mean, I'm sorry, my calls.
Okay.
And
All
I
right.
think the market will probably get hit. Something will happen. I think the global reflation trade is overbought. I mean, we have China and Europe. China just reported year-over-year decline in CPI for the first time since 2009. So they're exporting their deflation. If you look at the PPI, the producer indexes, I was actually just looking at them. Yeah, the European. This is the price.
There's Art Hogan.
Right.
An old guy like me.
China PPI. So if you look at China's year-over-year, PPI, as you see, they're exporting their deflation. So China's last 5 years. So you see, every time there's been like a big downturn in markets or like, weakness, it's China pumping last time this happened bigly was in 2015-16. And then China remember they did their big devaluation.
Right.
And then markets collapsed. So, things were going good for the first, 2017-18 cycle with the tax cuts and everything. But now Euro is the same thing. It's negative PPI. So there's a phenomenal book I just read by Michael Pettis and Matthew Klein. It's called Trade Wars Are Class Wars. And that book, I highly recommend it. Just came out in May, but it basically shows how China and Germany, and Japan, big surplus countries, are suppressing their consumption nationally to force big surpluses, because they have to export the excess because they can't consume it all at home. So for every surplus nation, there needs to be a deficit nation. But the big thing after 2008 was that China was supposed to take over. Remember that demand for commodities, everything was, hey, China is building these big, so after world demand collapsed in 2008, China didn't want to deal with unemployment and weaker growth, so they exported it abroad. They were dumping their deflation onto the rest of the world with their low cost, goods.
Labor.
And now the problem with it is, China's household consumption to GDP output ratio, it's like 40% of GDP. It's the lowest of any major economy because they keep it low on purpose, meaning that the other one that keeps it high is exports and investments. But the thing is, China's run out of positive returning, the low-hanging fruit investments. Like, they can only build so many apartment complexes and malls. They've already built they've already taken off the low-hanging fruit. So
Adam, is that why they have that policy? It's called, I believe, clean plate policy, where they're not giving them, it's almost like a they're practicing for famine by giving people less food and training them to consume less in the food arena.
So so Michael Pettit, there's the Hoku system. They have very poor social benefit system. There's like a lot of things in China that suppress consumption, because when you suppress consumption, you're increasing savings, and when savings is higher, there's more investment. So historically, the book goes into historical countries like the Soviet Union was a big example of harsh high savings model. So they have to force consumers not to spend, and they did that by, like, for instance, the Soviet Union was exporting millions of pounds of grain to Europe during the 1950s, while they're in the 20s to the 50s, while their people were starving at home, because the government had to sell that exports to raise capital to build their industries at home. So they had a very powerful military by exporting grains from their farmers that the farmers weren't allowed to keep, and people were starving to death in their own country. So that's an extreme model of the high savings model. Another good term for this, that China model they use, is it's called economic backwardation, and it's called the Gerschenkron model, and it's named after an economist, Alex Gerschenkron, and he wrote that countries like usually like third world countries, poor countries, have to force their savings rate higher. And the thing is that the government, does like they build big ports and big investment structures to like stimulate growth and employment and et cetera. But eventually they have to rebalance. So China was supposed to give more consumption, like America
Right.
was trying to force them, like, hey, you're a currency manipulator. Hey, you're, all these things like protectionist tariffs, the trade deals, bilateral trade deals Trump tried to do is try to get their consumption higher at our expense. But China's been fighting against it because it'll get rid of their surpluses, which means their dollar, their hoards of money. And their household consumption has actually declined since 2008. So that means they're forcing that excess on the rest of the world. And it worked fine up until 2008 when the rest of the world's growth slowed down as well. So now they're just dumping excess onto a already indebted and anemic world. So that's why with everyone talking about global reflation, I don't think you can talk about reflation until China or wages at home start rising. And wages have been, since the 1970s have been, there's actually a really good
So you're still
report.
in the secular deflation camp,
Yeah, so I look at deflation
except
as,
for uranium.
yeah, so
Special
there's price
situations.
changes. Yeah, well, so I mean, there is inflation every year, obviously, even if it's 1%. And last time I know we were talking about this book, I read The Great Wave, and it shows price inflation since the last 1,000 years. It's a really good book. I recommend it. It's called The Great Wave by David Hackett Fisher. He's like one of the best historians, but he showed since 1100 AD, there's been like big price revolutions, he calls them. There's been 4 big waves of like when inflation got out of control. And in those periods where inflation out of control, you had Napoleons, you had, uprisings, you had the Florence Empire crash, Spanish Empire crash, basically
Yeah.
during periods of inflation, there was like the Great Plague, blah, 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 horrible things happened. And then there's a big deflation period. Like the Great Plague was one of them. The bubonic plague, it like wiped out 20% of the population or something. So workers class, people who collect wages versus rentiers, the capitalists, were, had the power to negotiate better wages because there was less workers and et cetera. And but so the point of his thesis was, even if there's inflation like today, like 1 or 2% a year, it's still there. Like I believe there is inflation in the sense that, it's being devalued, but it's not like we're going to the grocery store and we're like, hey, there's, prices are 50% higher of all my goods I buy than last year. We usually go, hey, when I was a kid, or hey, like 10 years ago, I feel like I used to get more. It's like a slow devaluation, but eventually,
Invisible, almost
exactly,
invisible. Yeah.
exactly. But that's the thing, that even if it's inflation 1% a year, over 50 years later, that's a 50% decline in your purchasing power. It gets to a point, like a tipping point, when it becomes noticeable, and it's like, hey, like, prices are, this is weird. And he shows, David Hackett Fisher writes how back in the 1100s in France, there was like a big once a year festival where producers would come and everybody would come and artisans, and they'd sell their goods. And it first happened there, whereas after like 30 years of doing it, it was like he said inflation was like only 1% a year average, but just that 1 year, it became so noticeable after 30 years that producers were like, hey, prices have really devalued, et cetera, that they started raising prices. And once the producers start raising prices, it starts trickling, higher, like spiraling. So if there's one thing I've like not, I mean, who knows, what I know, but one thing I've seen is that for inflation to pick off, we'd really need to see wages increase, indebtedness go down. And I think since COVID, I mean, they're just pushing rope at this point, like money velocity is falling, wages aren't really growing. It's really hard to see how that money is going to pick up into the system unless there's a big marginal buyer. And I think the one thing the government did is this time, since 2008, I'm not really big on the fiscal side because that's temporary and it's not as big as an aggregate as it was when Keynes recommended it in the 30s. Like more people were doing ditch digging and, road building back then compared to now. Construction workers aren't the marginal, middle white class producing job anymore, like those kind of industries, like union workers. So we're in like the digital age now, where since the 1970s, there's actually another great book, but there's a great book called The Rise and Fall of American Growth. And the author shows that basically the first two big spurts in the US or in the world, Britain too, over the 1800s, and were the first two industrial revolutions. And since the 1970s, we've exhausted the marginal gain from those. For example, when we made electricity or plumbing or
Right.
whatever else, cars, it had to proliferate through the economy. But since the 1970s, that doesn't work anymore. Like the marginal benefit doesn't work for the average producer anymore, meaning that the marginal gains from the third industrial revolution aren't being passed on to the worker compared to the others. And there's an easy reason why. We're in the information communication age, digital age, meaning it's not revolution anymore, it's just evolution. Like that phone I'm buying now, like a 10th gen iPhone, is like slightly marginally better than a 6th gen iPhone. It's not as much as like, hey, we have to go install a new telephone in 200 million homes, or we have 200
Right.
million cars. It's like, oh, am I going to buy a 2019 Nissan, or my 2015 is fine? So it's all evolution, just smaller tech, and it's not proliferating like it used to, which is a
So
big
what's
chokehold on
next?
demand.
What's next? Do you know? What's
I
going to
mean,
drive it?
I think we're going to see a lot of universal basic income talk. I think because we're
Okay.
going to have more quote bullshit jobs where people just feel, these jobs are kind of meaningless, but the governments like France and China just pretty much employ people to keep them happy. I think we're going to see more of those kind of like remedial jobs, and they're going to start pushing more universal basic income. Maybe they'll start, like, as people go more into AI, they'll start taxing corporations for the AI to like pass on to people. I don't know. There's a great book called The Great Rupture by Victor Schvetz. He was a very famous macro analyst. He just published his book. I recommend, you checking it out. He goes pretty big into, how marginal capacity has declined and how, it's kind of a bleak outlook, but
Well,
I don't know.
While I have you on book titles, Barry would like to know the name of the author of Trade Wars again.
Oh, it's Michael Pettis. He also wrote the book, The Great Rebalance, which focuses pretty much on China's consumption to investment problem. And he wrote the book, The Volatility Machine, which is like one of my favorite. It's like the best macro book, one of the best macro books in my opinion. Super underrated. But yeah, Michael Pettis and Matthew Klein wrote Trade Wars or Class Wars.
The power of reading, the thirst for knowledge, exemplified in my trading warrior brother, Adam
Yeah.
Tumerkin. Really, you are. And, I want to wish you and your family, great holidays, and stay healthy, buddy. And we'll do this again next year. I really do appreciate your presentations every time you come in here. And it's almost like I feel energized by just listening to you, because I could feel your passion for what you do. So
Oh, absolutely, man. I mean, thanks for having me. And, I always like speaking with you and everything. It goes by really fast.
yeah, I'm telling you that you're one of the more better read people I've ever interviewed, and your ideas, be a great guy to have a few beers with and talk about this stuff. And who knows, I'm glad for now, at least, our paths have crossed on Twitter, and that you're a regular on Face now, Adem. Thank you very much, buddy.
I appreciate it. Thanks for having me, sir. And yeah, same to you. Hope you guys all have a great holiday.
All right, buddy. And
All right,
good
take it
luck
easy.
on your dollar bet. I actually,
Right.
well, maybe I shouldn't say it. I agree with you.
Well, oh
You
yeah. I
better-
mean,
all right.
who knows? But
Yeah.
take it easy, Dale.
All right, buddy. All right, everyone. You can follow Adam at Radical Adem. I believe there's no hyphen or anything on it. And go to his website, speculatorsanonymous.com. So there it is, Radical Adem, and check out what he has there. So that's going to be a wrap, everyone. We'll finish the week off. Oh, no, today's Wednesday. I almost did what Kevin did today. So I'll see everyone tomorrow. And also, we're going to have Michelle Schneider at Market Minute. And enjoy the rest of your day. Adios, everyone. Don't forget, don't just count all the books that Adem has read. Count your blessings. See everyone tomorrow. Adios.